What's up, everybody? It's Friday, July 23rd. Yeah, Friday. All right, markets rallied to new highs today. I gotta say that I give a lot of credit to the Fed in their reverse repo operations. This is the reason why we have seen the market come back from that big sell-off last Monday and rally up to new highs. It's been a brilliant workaround to the reserve situation and the constraints that the banks are under with the regulatory stuff with the supplemental leverage ratio and all that. I mean, it's been a genius workaround, and it is the thing that has helped the market go higher, and I have evidence of that, and it was what I was suspecting. I just looked at the data from the weekly H8 Fed release, comes out every Friday at 4:30 Eastern time. In the week ending, let me get this right, July 14th, all right? So these reports are 1 week backdated. They're 1 week lag. But anyway, it was an interesting week because in the week ending July 14th, we had a reserve build of $104 billion in that week. Now, that's not one of the largest reserve builds in a week, but it's up there, okay? Once you get over $100 billion in a week, I mean, that's significant. And ordinarily, like in past times, if you would have had a build like that, and that was the second week in a row of reserve increases, you would have seen liquidation in the financial markets because, banks would have been up against the wall under those constraints. They would have had to liquidate some assets, and probably it would have been trading assets. Banks keep a portfolio of trading assets. Those are derivatives and commodities and Forex and stuff like that. They would have liquidated that just to maintain a good buffer within that supplemental leverage ratio to make sure. They always want to make sure they're well above that ratio. And I mean, I have seen this correlation in the past, and it is a very close correlation when you see these changes in reserves. When you see big reserve additions, the markets in the past, particularly equities, they used to sell off. I mean, it was a very close correlation. Now, what the Fed has done, and this has been ongoing now for several weeks, it has been very active with these reverse repos. I've been talking about it. And reverse repos is basically, as I described it yesterday, it's like sweeping that cash off the bank's books, and the Fed's holding on to it, okay, paying a little interest on it to the banks. So it's sweeping that excess cash off the bank's books, and that allows the banks to accumulate other assets, whether those be, treasury collateral, or in this case, we saw in that week in question, big increases in trading assets. And there's a line item on that report called non-MBS, and that includes certain types of equities. As a matter of fact, we had like a 14 billion increase in non-MBS. I look back, that's probably a record 1 week increase. And we saw also a 14 billion increase in trading assets. So almost a 30 billion increase in like equities and derivatives. That's what pushed the market up. I mean, this came at a time when, I was talking about a modest slowdown in the fiscal flows. By the way, the fiscal flows look like they're picking up again. So right now, I have to say, like the Fed has been, this has been like a genius tactic. If you're talking about keeping the market up, and giving banks some breathing room. By the way, in that week where we saw the $104 billion in reserve increase, loans went up too. I mean, loans are assets that also maybe not would be liquidated, but you'd see a slowdown in loan growth or maybe a little bit of a contraction in loan growth. I mean, it's been a remarkable operation, and as long as it continues, all right, because look, we're coming into the debt ceiling. Everybody knows this. It's not, I doubt very, very highly that it's going to be increased or suspended. I mean, there's no Republican in the Senate that's going to go for it. Yellen just put out a letter to the Congress saying, you know, she could probably, you know, work with extraordinary measures until October. So, I mean, she's not exactly injecting any, you know, immediacy into this thing whatsoever, right? October, that's like freaking, who's thinking about October right now? So, you know, Congress is going to get this letter and say, okay, we got till October, we don't have to do anything, we could sit on our hands. And that means there's 590 billion in the TGA. I mean, that thing could go basically down to zero. We could get another 600 billion. Now, if this was happening without that Fed operation, I mean, the market would be down like 40%. I'm certain of it. So it's going to get, I mean, it's pretty wild. I made a video a couple of days ago saying we might have a melt up. You know, I mean, that's possible. That is really possible. Unless we see a string of weak economic data. And, you know, we got a little inkling of some weakness on Thursday when we saw unemployment claims pop up to 419,000. But other than that, I mean, I think we had, market PMI. We had one of those PMI, Purchasing Manager Index things today. Manufacturing was strong. Services were weak, okay? The COVID thing is going on. I don't know how that's going to impact, but we either need to see a consecutive string of weakening economic data. If that doesn't happen, then just technically, and by technically, I don't mean charts and lines on charts and chart patterns. I'm talking about what the Fed is doing right now in terms of these operations. That is really, you know, allowing the banks. And by the way, I just should add that all of this is just telling you how strong the banks are right now financially. I mean, it's incredible. I mean, when you know, people selling bank stocks right now because interest rates are low, that is crazy, man. I mean, the banks are so well positioned financially right now that when we come out of this, whatever this is, you know, the concerns or whatever, I mean, bank earnings are just going to blow through the roof. Right now, they're sitting on record capital. And capital is the only constraint to bank lending. All right, it's not reserves. I went over that. As a matter of fact, I explained to you how reserves inhibit or limit the ability of banks to lend, okay? It's capital. And I mean, they're flush with capital. You know, the Fed is sweeping all this cash off their balance sheets to help them with this situation. And, you know, they're just piling into other assets, loans, equities, trading assets. I mean, it's incredible. It's a testament to how strong their balance sheets are right now. So anyway, that's what's going on. I mean, you know, it's interesting because, you know, a lot of times, and this, I've spoken about this in the past, it kind of goes back to my floor trading days. Like, there are technical things that drive the market, you know, big orders, embedded positions that have to be unwound, right? Operations by, you know, let's say fiscal flows, payments that are made at particular times of the year, large payments or large amounts of taxation, like when taxes are due. I mean, all these things are predictable and knowable. they create, it's like throwing a rock in a still pond of water. I mean, there's the ripple effect that goes out. Same thing that's going on right here, right now with the Fed with these operations. You got to understand this. If you do, it makes the whole thing almost like a risk-free operation. I mean, you don't have to worry. I mean, if you understand that these things are happening and they have this particular effect, I mean, you could basically buy and sit back and just, watch it happen. I needed to see the evidence. I just saw it. So, we're looking good. Anyway, have a great weekend. And I'll try to make a video over the weekend. If not, I'll see you on Sunday or Monday. Bye.